This morning, the ISM number came in at the highest level in 4 years. Just absolutely juggernaut. Now, for me, it was a dream report. All the arrows moving in the right direction. If you look at the new orders, production, inventory, all of these things, prices, by the way, moving lower. It was just absolutely phenomenal. However, it is the kind of stuff that provides fodder for those that want to hike rates. America's getting a raise, and that scares a lot of economists. Now, this, as the media, the financial media, has now latched onto a new term, Fed credibility crisis. Let's bring it to the best. Troy Ludtka, SMBC, Nikko, Securities, their senior U.S. economist, along with Chris Lowe, FHN Financial chief economist. Chris, let me start with you. Just, golly, I want to be able to celebrate a number like this. And this is what I really want to mention to the folks. So employment rockets to 52.8 from 49.7. It's gone from contraction into, expansion. I want to see that go. But, some people are saying, time for the Fed to stop this before it becomes a wildfire.
Look, first time manufacturing's really been healthy since 2022. We've got persistent growth every month in orders, production, and now for the first time in a long time, we've got the employment index back above 50, but it's just the beginning. And I think it's also an indication of this sort of broader growth that's happening in the U.S. with a desire to bring production back onshore because of the tariffs.
Right. But Troy, here's the thing. Overall economy, to Chris's point, growing faster for 21 months. It's growing and it's picking up the pace. Manufacturing has been growing for 7 months and it's picking up the pace. And again, for a lot of folks, traditional economists, I know at your shop, you guys are looking for rate hikes. This would be fuel to the fire, right? This would be another reason maybe to slow down the economy.
Yes. The U.S. economy is in exceptional health. And the cyclical sectors of the economy, these are the sectors that actually have high multipliers. They tell you something about where the economy might be heading. These sectors are now reaccelerating for the first time in 4 years now. And if you look at the unemployment rate, we're at 4.2%, ultra low by historical standards. Inflation has been above the 2% target for 5 years now. This is going to make it 6 when all is said and told. At some point, the Fed is going to run out of patience, and you're beginning to see that reflected in their various remarks. So
now here's the thing. On that note, the Journal had an article the other day. Walsh makes markets do their job. And then part of it says, memo to Wall Street, quit whining about the Federal Reserve. Your clients are paying you to make judgments about risk and returns in real time. And it's embarrassing when you complain now that Daddy Fed isn't telling you how to do it. Is there any fairness to that criticism, Chris?
Yeah, I think so. But that said, I think it is probably appropriate to raise rates at some point this year. And I wouldn't be surprised if they go in September. However, what Walsh is doing, and I like the way he's characterizing it, is he's drawing attention to the fact that financial conditions are already quite a bit tighter than they were after the June meeting. So with financial conditions tighter, there's less urgency to hike. Effectively, what we've done is we've taken interest rates up already for the Fed. However, they do have an iron grip on those short-term rates. They haven't moved. And so if you want all interest rates to be higher, the Fed's got to join the party.
The question is, how do we interpret these higher yields, right? So, for instance, the 30-year bond, Troy, is it a reflection of economic growth, and should we be upset with that? Is it a reflection of demand destruction with the Bank of Japan having to defend the yen, selling treasuries? Or supply increase, the Treasury Department, we got a pretty bloated budget in this country. Or is it more reflective of destructive inflation? Like, which, if you had to pick one of the four, which one would you pick?
Yeah, I think the case is pretty clear that this is part of a global up move in bond yields. This is not just a U.S. story. You're seeing it in Japan as well. The economy, not only in the U.S., but also globally, is in very strong shape, and we think it's basically those two forces.
What about so I had 2.5, maybe 3 years ago, Jim Grant said, hey, we've entered into a bond bear market. So many folks on the street are, 40 years we were in a bond bull market. So I would say 90%, maybe 95% on Wall Street don't even remember when there was a bond bear market, but that lasted for 40 years. I guess the question I'm asking is there anything that can be done if we're in some sort of structural bear market that's going to last for 10, 20, 30 years. How much should we try to change that?
I would say we need to expand capacity. We need the economy's potential output to grow. That requires a lot of investment in labor-saving technologies such as AI and robotics. And then there's the other part of it, which is we need to expand the workforce. We need more people working. That'll put a cap on wage growth, unfortunately, but it'll also bring inflation and interest rates down broadly.
But here's the thing with the AI stuff, right? So I read a piece over the weekend, Lori Logan, 2024. She sounded like Kevin Warsh. She spoke really positively about the AI trade, AI data centers and investment, and the ultimate productivity boom that could come along with it. But it feels like, for now though, because it's adding to GDP, it's frowned upon.
Yeah, look, that's the short-term versus long-term.
Right.
And Warsh addressed that when he testified to Congress the other day, saying absolutely short-term. You know, they're every chip that's produced, they're buying. This huge pressure
Right.
to increase the size of the electrical grid, which is increasing the cost of everything there too. But that's the short-term. Long-term, you get the productivity payoff, which is absolutely deflationary.
Real quick, because we're out of time, but I have to ask this. It's pretty clear in my mind that one of the things that Warsh is trying to do is buy time, get these committees to rewrite the rules, if you will, or however we interpret things, mostly inflation. He sounds hawkish because he says we're going to get to the 2%, but I also think if you use, for instance, Dallas Trim Mean, we're at 2.4%. He thinks we're closer than his colleagues. What should we use quickly to measure inflation? What should be our main way of measuring inflation?
We like the median and mean. We think provides the strongest signal of where inflationary pressures are, but also where they could be heading. And we think it's interesting because if you look at wages, they're running at just 3.5%,
right,
which is right where they were pre-pandemic, which doesn't necessarily signal to us that any sort of inflationary episode that we're seeing now is entirely durable.
I'm with Troy on that. I think the median and the mean are great if they can also improve the turnaround time by bringing some of the elements used in the Trueflation Index. Yeah, absolutely. Do that too. The more we know, the sooner we know, the better.
Troy, Chris, thank you both very, very much. Appreciate it. All right, folks.